Harshvardhan.
Yes. So, welcome everyone to the Union Budget Analysis Part 2, the Indirect Tax GST Provisions session. Hello? Hello?
Go ahead, Harshvardhan, you're audible.
Yes,
Yeah.
yes, you are audible.
Yeah. So, welcome to the Union Budget Analysis Part 2 session on indirect taxes. We are
Harshvardhan, you have to unmute yourself.
okay. So, we are most fortunate to have with us CM Mandar Telang sir as the speaker today on these indirect tax provisions of the Union Budget. I sincerely welcome him to this webinar, and I request our member CA Palak Tikmani to introduce our speaker today. Palak, ma'am.
Thank you so much, Harshvardhan. A very good evening to Chairman Asawa sir, members of our managing committee, our speaker Mandar sir, and my all fellow members. It is my pleasure to introduce the speaker of our today's session, CA Mandar Telang sir. Let me give you a brief introduction. So he is a partner at Gokhale and Sathe Chartered Accountants. His areas of expertise are service tax, MVAT, CST, and GST. He has been a co-opted member of Indirect Tax Committee of ICAI from 2016 till 2018. He is MCM and convener of Indirect Tax Committee of BCAS. He is a member of Indirect Tax Committee of Chamber of Tax Consultants. He is a vice chairman of Journal Committee of Chamber of Tax Consultants. Also, apart from this, he has authored a publication titled Service Tax, Basic Concepts and Procedures. He is a regular contributor to Chartered Accountants Journal and BCAS Journal as well. He has also acted as a panelist, expert faculty in webinars, refreshers, study courses, training programs as well. He has actively participated in representations relating to GST before central and state authorities. He is also a NASN certified GST trainer. So undoubtedly, we have an expert faculty for our today's webinar, and I'm sure we'll have an excellent session today. And without taking further time, I invite Mandar sir to begin the session. Happy learning to all of you.
Sir, just before you start, just 1 minute. Shiv sir, would you like to give a few opening remarks and then we'll proceed with the session?
Yes, yes. Basically, probably this will be the last seminar as chairman of Thane branch. Respected participant and my colleague in Thane branch, good evening to all and everyone. I, on behalf of Thane branch, welcome you all in this VCM on Union Budget Analysis Part 2. Particularly, will be dealt with GST provision. And today we have CA Mandar Telang as a speaker. We team Thane branch are extremely delighted to have you and all participants in this seminar. Most probably today's seminar will be last one as chairman of Thane branch. From here onwards, new team and new chairman will take over. We have very young team for the term 2022 to 25. All MCMs are very energetic. Today's seminar is again brainchild of or initiative of newly elected MCM Omkar and Harshvardhan and Palak. Big round of applause to all of them. Now, announcement, respected members, today's seminar will be interactive. If you have any question to CA Mandar, please feel free to ask. I will prefer that you put your question on chat box or raise your hand so that session chairman Omkar can pick it up, all those questions for, or Mandar himself can look into chat box and reply your queries. And the final reminder that your Zoom name should be your membership number followed by your name. Please do not blame us if we cannot upload your CP credit due to non-availability of membership number. Now I request Omkar Gadgil, chairman of the session, to take charge of the further proceeding and invite today's speaker, CM Mandar Telang. Thank you all and everyone.
Thank you, Shiv sir. With the greatest pleasure, I invite now CM Mandar Telang sir to please begin with the budget discussion for the day. It is obviously an honor to hear him again. So, sir, please proceed. The said stage is all yours. Thank you.
Thank you, Omkar. Thank you, Shivji, for such a warm welcome, and thank you, Palak, for a great introduction. Namaste, everyone. So, at the outset, let me give you one disclaimer or sort of a warning that with after I finish my session on today's topic, I certainly do not intend to spread any hatred, especially on this lovely day, about your love about the GST provision. So please forgive me if what I'm going to tell you is only the facts and my views on certain budgetary provisions. So if it brings certain hatred about the GST provisions in your mind at the end of the session, I'm very sorry for it. So this is a statutory warning. I don't want to take any blame on myself for that. Okay. So let's begin with the session for the day. GST amendments which are proposed by the recent budget 2022, Finance Bill 2022, and I would, if you ask me to describe this entire indirect tax budgetary provision in one sentence, then having regard to the principles which we generally apply to the bundled services, if we try to bundle all this provision and give one essential character as to how I describe this budget as, I would say it is a condition supply budget. Okay, it's a condition supply budget. So you go to any insurance company and you take a policy, and after you get the standard form contract, you sign it, or many times when the advertisement comes, they promise you good returns, and then there is a small asterisk saying condition supply. uh, and suppose something goes wrong and you go to the insurance company to claim that particular maturity or claim that particular benefit, if some event happens, and then they point out to you that this is a condition which you have violated, so we will not give you the money. What would happen to you? Okay, something similar I would perceive would happen to the taxpayer if, as a result of certain conditions or restrictions applied, probably not necessarily which are within their control, if the benefit of an ITC is denied to an SSC, then what would happen? So that is what is going to be the focus of the today's session. I would basically be covering those provisions, how it is going to affect the recipients, taxpayers per se, and also how it is going to affect the tax consultants. So both these things I'm going to highlight a bit in the session today. And if I try to tell you the basic framework of this entire budget, then I will divide the proposed amendments into two parts. One is the amendments relating to the input tax credit, and another is other amendments. And when we are talking about other amendments, again, if we try to further go into the smaller buckets in the other amendments, then some of them are relating to the making the compliance more stricter, or which with a greater focus on the timely compliances. So that is one focus area. Another focus area is some simplification, trade simplification measures. So that is again a second area. And the third area is basically some of the retrospective amendments, which are also a sort of a corrective or the beneficial in nature. So these are the three other areas in the other amendment. And then obviously there are some other residuary provisions. So like that, the entire budget can be divided into 4 to 5 paragraphs. So let me start with the first class or the first type of change, which is going to affect many individuals, which is going to affect many taxpayers. That is this amendment in the input tax credit. So before going to the main amendments, let me tell you how the framework was as of now there in the GST Act. So initially, when the GST Act was enacted, was July. The promise was that it's a one nation, one market tax, and we want to prevent the cascading effect of taxes. There should not be a tax on tax. So you should be in a position to get maximum input tax credit. And therefore, as long as you get an input tax credit, there will be low cost, and all the inflation related problems will also be solved. So this is how the concept with which the GST was introduced. And if you ask me, according to me, the ITC, input tax credit, is the soul of this entire mechanism. So if you fail to give the input tax credit, then in my view, the tax mechanisms or the concept with which this tax has been introduced is really failing to achieve its desired objectives. Some provisions, some problems in the input tax credit were already there. Like for example, in case of a hotel related services, the credit is not available if you don't have the registered address in the place where the hotel is located. So there were certain fundamental issues which were there even from the beginning, but those were sort of a policy because it was trying to safeguard the states which were otherwise dependent upon that kind of a revenue. So some are definitely some provisions where there was a blockage of the credit was based on certain policy issues. But right now, if you ask me what are the proposed amendments are, they are no doubt a substantive amendment, but the procedures prescribed to achieve the objective of those substantive amendment, in my view, are a little bit harsh. And this procedural strictness or rigidity is going to create a lot of problem in a time to come. That's what my frank view is. So before coming to the current provision again, the concept was very simple that it's a self-assessment regime. So there will be a taxpayer or there will be a supplier who will supply the goods, who will raise the invoices. After he raises the invoice, he will upload those invoices in his return, which is GSTR 1. Then those returns will be those particular statements, when he uploads the return by say 11th or 10th of the next month, it will be made available to the recipient. The recipient will be able to either accept that particular credit which is appearing as a result of the upload. If somebody has missed uploading, then the recipient will add. If somebody has made any error in uploading, that particular person will deny that particular credit and add his own credit. So like that, there were rights given to the SSE, to the recipient, to make any modification in the uh, uh, in the credits that is getting uploaded by virtue of the GSTR 1 filing of the supplier. And then finally, there was some period which was given before 20th, which is the due date of filing the return, for both the parties to rectify their mistake. If the parties could rectify their mistake, then in 20 the auto-generated GSTR 3 was supposed to be generated. And suppose the parties could not rectify that particular mistake with before 20th, then also after the filing of the return under section 39, there was a mechanism which was prescribed under section 42 and 43 for the purpose of identifying this mismatch and taking a corrective action on that. So this was a two-way communication, one from the supplier, another from the recipient. Supplier was was under the position to file his return based on his books of accounts. The recipient was in a position to file and claim his input tax credit based on his books of accounts. And if there are any anomalies or there was any mismatch, then the law provided that this mismatch will be communicated to both the parties, and either party should take an action on it. And depending upon how the action is being taken, the either of them would be required to suffer the consequences, like either reversal of a credit along with interest or payment of tax along with interest. So a very simple, easy to understand, a logical concept which was introduced at the time when the GST Act was promulgated. Unfortunately, although the system looked very easy, the mechanism to introduce such kind of a system was not available. Somewhere it felt that in spite of the system not being ready, the law has been implemented, and therefore to that extent uh, some amendments were made in a unofficial manner. So the GSTR 2, which was a amendment or which was something to upload the self-generated return or on a self-assessment basis to claim the input tax credit, that GSTR 2 was basically deferred. Similarly, GSTR 3, which was an auto-generated return, was deferred. And then we were we were left with only two returns, that is GSTR 1 and a GSTR 3B, which was a consolidated amount. So that basically resulted into the differences between filing of a statement and making the payment of tax, because the taxes are required to be paid along with the GSTR 3B. So that basically brought this disconnect. So the immediate question was how one can identify that the other party has made the payment of tax. He may have filed the returns, but he may not have paid the tax. So that is the first question that happened. But slowly the system got developed, and we got to know the information from the various reports which were generated from the GST system. So this is how the initial days the GST was being enacted, it was being implemented. There was a something like GSTR 2A. So a lots of hue and cry was happening that if the invoice is not appearing in GSTR 2A, then you are not allowed to take the credit. Then there was certain rules were introduced prohibiting you from taking the credit unless and until the goods, unless and until that particular credit is appearing in GSTR 2A. Then the correctness of that particular rule or the wires of that particular rules was challenged before the court, because somewhere it felt that the rules are going beyond what is the mandate which is prescribed in the act. Then accordingly certain laws, section 16 underwent a change. Some new sections were brought, but some of them were implemented and some of them did not really saw the light of the day. So this is how the entire mechanism was getting developed. And now whatever was statutorily not there, but which was happening in practical life, somewhere the attempt has been made to give a statutory force to all those items or to all those activities which were happening informally under the GST regime. So the if I go by amendments, I will start with section 16, which is a basic conditions for the purpose of availing the credit. Now one has to understand what is the basic scope of section 16. In my view, section 16 only tells you that what are the basic requirements for the purpose of availing the credit. Now those requirements which are mentioned in section 16 need not be satisfied at the time of availing the credit. So in my view, those conditions may have been satisfied either at the time of availing the credit or it could be satisfied even subsequent thereto. But as long as those conditions are satisfied, either at the time of taking the credit or subsequent thereto, in my view, the credit claim should not be disallowed to any person. Like for example, I'll give you an example. One of the condition, the four conditions, four simple conditions. I will come to the fifth and sixth conditions later, but the four simple conditions for the purpose of availing the credit was that the SSC should be in receipt of the invoice. The SSC should be in receipt of the goods or services. The SSC should have filed his return. And fourth, the supplier should have made the payment of tax to the government. So these were the four basic conditions: possession of the invoice, receipt of the goods and services, filing of the return by the recipient, and payment of tax by the supplier. These were the four important conditions. Now, in my view, suppose the invoice is raised on you, but the goods are not received by you. They are received by you not in the same month, but in the subsequent month. In my view, it would be still possible for the SSC to claim the credit, because according to me, the condition that the goods should be received is not a timing condition. Section 16 does not tell you the time for the purpose of availing the credit. It only tells you that unless these conditions are fulfilled, your basic eligibility of the credit is in question. If these conditions are fulfilled either at the time of availing the credit or subsequently, the eligibility of the questions cannot be questioned. That is according to me the purport of section 16, because section 16 is on eligibility. It's a substantive provision. It's on eligibility. It does not decide when you should take the credit, but it should tell you as to, and not in what point in time, but it tells you under which circumstances the credit should be made available to you. So that is what the basic scope of section 16 is. The another question, another example. Suppose the person who has supplied you the goods did not pay the tax in the same month, but he paid the tax in the subsequent month. The question is, can the credit which is availed by you be denied to you because he made the payment of tax in the subsequent month? So are you in a position to go and check every time whether the taxpayer has made the payment of tax to the government or not? So again, there I believe still there is no requirement, there is no possibility for the SSC who is receiving the goods to check whether the supplier has made the payment of tax or not. But at the time of taking the credit, but it is in O's interest that he has to check whether the person has paid the taxes or not, because if he has not made the taxes, then the eligibility criteria under section 16 will not be fulfilled, and to that extent his credit will be in danger. So one needs to take, when there are conditions on the input tax credit, in my view, one needs to take a little bit balanced of the views. If the conditions are not getting fulfilled, then no doubt you are not entitled to take the credit. But if the conditions are getting fulfilled, only the timing of the fulfillment of the condition is changing, or the procedure which allows you to identify or to check. So if there are three procedures prescribed in the law for you to identify whether a particular person has paid the tax to the government or not, if those three procedures are somehow failed, and if there is a fourth procedure which is not mentioned in the law, but by virtue of which, if you are in a position to prove or establish that the other person has made the payment of tax to the government, in my view, the interpretation which would allow the credit should be adopted, because one needs to interpret. So once the substantive right, once it is proved that the substantive right under the ITC is available to you, and in principle you have fulfilled both the all the conditions, then the mere fact that the testing of fulfillment of the conditions is not given in the law, and you are relying upon some external mechanism to prove that, according to me, should not be fatal to do your claim of an ITC. And with this perspective, in my view, one should look at the entire ITC provision to make the law a successful law. So this is the preamble with which I will now start as to why I am a little bit upset about the manner in which these provisions have been introduced in the law, the conditions, the restrictions over the conditions. So what has happened? So the first condition is that they have introduced is section 16. So earlier in the last budget, they had introduced one condition that the supplier should upload the invoices in GSTR 1, and the uploading of the invoice should be communicated to the SSC. So now, as far as the uploading of the invoice in GSTR 1 is concerned, it is the supplier's responsibility. But the communication of those invoices to the recipient, that is not supplier's responsibility, it is a government responsibility. What government did is, in order to communicate this particular uploading to the recipient, they came out with the mechanism of GSTR 2A initially. Then they realized that this GSTR 2A mechanism is not a foolproof mechanism, because it keeps on changing every time. And in order to give a certainty to this particular credit mechanism, we need to have a unique document. And therefore, they came out with something called as the GSTR 2B. Now, when you are coming out with something called as the GSTR 2B, and when you say that it is a static document, it's a static report, then obviously you need to decide what is the periodicity of that particular report. It cannot be generated each and every day. It has to be generated on a particular day. So they decided that when it comes to GSTR 2B, it would be generated immediately on the 12th day of the next month. So if you are filing a return for the month of July, then the GSTR 1 due date is 11th. So this particular report will start on 12th, and which it will cover all the invoices which are uploaded on the portal from 11th of the July till 11th of the August. So for the month of July, the report will be generated on 12th of August, which is immediately after the expiry of the due date of GSTR 1 for the month of July, and it will carry the information pertaining to all activities that has happened in the last 1 month, that is from 12th of July to 11th of August. So that is how the cutoff dates were prescribed. Now, if you look at 12B, what happens today is that if a particular person who has supplied you the goods in the month of July, has issued you the goods in the month of July, has filed his GSTR 1 not on 11th but on 12th, then in GSTR 2B, that particular invoice will not be reflected, because that particular invoice will be reflected in the GSTR 2B of the subsequent month, but not in the same month. The question then arises as to whether for that particular month, the assessee who has already made the payment of GST to the receiver, to the supplier, is entitled to take a credit or not. So look at the scenario that A supplied goods to B in the month of July. B paid the entire consideration along with GST to A in the month of July. In the month of August, on 12th of August, the GSTR1 was filed by A. Say on 18th of August, GSTR3B was also filed by A. So as far as his supply is made in the month of July, Mr. A has not only filed his return, GSTR1, but has also made the payment of tax to the government in well before the due date. Now, when it comes to Mr. B, the question lies as to merely because there was a 1-day delay in filing the return by Mr. A, Mr. B should be denied the credit in the same month or not. Friends, it's very easy for one to say that don't take the credit in month A, take the credit in month B, that is in the subsequent month when it starts appearing over there. But all of this will have a tremendous cash flow implication when it comes to traders. So that amount could be as low as 12,000 rupees or it could be as high as 1 crore 20 lakh rupees. So depending upon that, if there is a very high stakes involved, then it would certainly result into some sort of a disputes between the supplier and the recipient. That because of you, because you did not file the return in time, I could not take the credit in this month. So you pay me the interest because I have already paid you the GST. So to that extent, there is a cash flow. So either you pay me the cash flow to make the payment or you pay me the interest. So this is a very serious implication. Now what would happen? This implications, this particular dispute will ultimately come down to the tax consultants, because why tax consultant delayed that particular return by 1 day? So it will come back to the tax consultant. See, this sort of a mechanism will then disturb the entire atmosphere. So if a tax consultant is being asked to file all the returns in time without making any simple error, then according to me, that is a very impracticable thing. There will be some error. We are all human. It's not a machine job. It's a human job. So there will be some error. Ultimately, the submit button has to be pressed by the by the person only. And therefore, in my view, in all such cases, if this particular provision is not really simplified or is not clarified in a proper way, this particular matching of 2B in the same month is going to create a lot of trouble. It's going to create a lot of problems for the industry. And therefore, this is the first take which is coming from section 16, is that whenever something is coming in 2B, the first need that is to be clarified is that if that particular thing is coming in the 2B, not of the same month, but in the subsequent month, then should the credit be allowed on a provisional basis in the same month or not? So this is one aspect that one needs to really see, examine. In my view, it would be possible to claim that particular credit in the same month. However, there are different views which are going on as far as that particular provision of the law is concerned. So in order to make the law simpler, it is expected that the government will come out with some beneficial, looking at the objective. When the government has already got the tax along with, and the filing is also done, and for that 1 month deal, they have already got that 100 rupees, whatever 100 or 200 rupees late fee. In my view, there should not be any other repercussions of that 1-day delay. So that is what the first aspect is. Now, what has happened in the current budget? They have introduced another provision under section 16. So last budget, they introduced this provision where 2B was given some sort of an authentication. The communication of the credit which is there in the 2B is made one of the conditions. So if something is not appearing in 2B at all, then whether you would be entitled to take a credit or not, that particular part they have addressed by incorporating the condition 16(2)(b) in the law from 1st January 2022, 16(2)(a) from 1st January 2022. Now in the recent budget, they have further drilled it down. How they have drilled it down? They have said that only condition that you have been communicated, that the other party has uploaded the return, and you have been communicated that the return is getting uploaded and your invoice is appearing in 2B, is not sufficient for you to take a credit. Now this is the condition supply budget. They said you have to further check that whether that particular credit is appearing in your GSTR 2B as an eligible credit or as a restricted credit. If that particular credit is appearing in your GSTR to be as an eligible credit, then you should be entitled to get the credit. You can avail that credit fully without any condition or without any restriction. But if that particular credit is appearing in your GSTR 2 as a restricted credit section, then you are not in a position to avail. You cannot avail that particular credit. So that is the additional condition that they have imposed in section 16.2. So one will feel that there must be some genuine reasons for you not to take that credit. So look at the case where the government, the person has already filed a return, it's appearing in your his GSTR 1, that particular credit is appearing in your GSTR 2B, but still the government, as a result of certain conditions, feel that you should not take the credit. Now one needs to really see how far those conditions are in line with the statutory intent. Suppose in these circumstances you have already made the payment to that particular person, that particular person or the supplier has already paid the payment of tax to the government, he has also filed his return in time, and still if the government tells you that you cannot take the credit because it's a restricted credit, then whether such a provision can be said to be a legal provision or not, that is a question that one needs to see. And this brings me to the conditions as to the indicative list, or I would say the exhaustive list, whatever way you look at it, the list of circumstances under which the government has said that they can restrict the credit, they can ask you that you cannot avail the credit in spite of the fact that that particular credit is being shown in GSTR 2B. So what are those cases? So let me take you through those cases one by one. So the first case is if your supplier has obtained a new registration. So if your supplier has obtained a new registration, if he has supplied you the goods, if you have made him the payment, if you have made him the payment of taxes also, even if he has filed the GSTR 1 in time, even if he has filed GSTR 3B in time, still up to a particular prescribed period, which could be 1 month, 2 months, it would be prescribed only by the rules. Up to a particular period, the credit on that particular supply made by him will appear in your GSTR 2B as a restricted credit. What is the logic behind it? Probably the government wants to find out whether that particular person who has taken a new registration is a genuine registration or not. Is it that it is not a fraud dealer, that he has got a good track record of making the payment? So in the absence of any track record, we will not allow you to take the credit. We'll allow you to take the credit only when some track record is established. Now that period could be 1 month, 2 months, 3 months. We don't know. It will come only by way of a rule we would be able to know. But one needs to seriously debate when this kind of a condition comes. When you have paid the taxes, what repercussions it will have on that particular person. Probably some people will say, if your credit is appearing as a restricted credit, we will not make you the payment of the tax at all. We will make you the payment of the tax only after the restriction is over. So a person who has started a new business, have taken a new registration, if there is such an unrestricted condition that in spite of the fact that you doing everything properly for the first 2 or 3 months, still we will not allow other people to take the credit, probably the recipient may not remit that much tax component to him during that restricted period, and he might face a cash flow problem. So this is one aspect that one needs to really see. We don't know to what extent the legality of this provision is would be upheld, but definitely this is not a welcome or a trade facilitation measure when it looks at a particular provision. Now, what is the second possibility when the credit will be restricted? If any person has defaulted in the payment of tax beyond the prescribed period. So if the supplier has defaulted in the payment of tax beyond the prescribed period, then his credits will be falling into the restricted credit category. Now, couple of questions may arise in this interpreting this. Number one, what do you mean by default in payment of tax? Okay, how the system is going to know that there is a default in payment of tax? Say, for example, suppose I did not make the payment of tax because I feel the tax is not payable. The government issue me the notice and say that you have to pay the tax. I am disputing that particular provision, saying that I am not required to make the payment of tax. Can I be said to be a person who has defaulted in the payment of tax when I am actually challenging the levy itself? That is one question. Another question, a person may have shown 1,20,000 in his GSTR 1. But suppose for some reason in his GSTR 3B, he has said there was one additional zero. So he had shown an additional, instead of 1,20,000, he said 12 lakh rupees. He can't change that particular GSTR 3B. So he also made the payment of tax in order to process that particular return. Now, merely because in the GSTR 1, less amount of credit is there, and the GSTR 3B, more amount of credit is there, whether this difference would have any implication on this particular credit. It could be the reverse situation, that 1,20,000 may be shown in GSTR 1 and 12,000 may be in GSTR 2B or 3B. In that case, can it be said to be a default in payment of tax? So this is the second alternative. So how the system is going to check whether a particular person has made a default in the payment of tax? That's the second aspect that one needs to see. The third aspect. The third case is in that case whose output tax payable under the GSTR 1 during the prescribed period exceeds the output tax payable in GSTR 3B during such period as may be prescribed. So the deviation between the GSTR 1 and GSTR 3B, which I just mentioned, if that deviation is there for a prescribed period, then there will be a restricted credit category. Now again the question comes as to would this restriction or this deviation be looked at on a monthly basis, or it would be looked at a cumulative basis, or how? Today there is no guidance as to how this particular mismatch would be looked at. We all know that many times due to rectifications, there is always a difference between a GSTR 1 and GSTR 3B, and you already have the reasons for those differences. But the question is, would the system will automatically identify such cases and put you directly to the restricted credit category without giving you any opportunity to set right or to put your position? That's the bigger question. In fact, section 38, when it comes to section 38, about which we are talking about, this section 38 now says that eligible credit and restricted credit, these will be the two categories. Section 38 is to be implemented, is to be acted by the government. So who will provide that communication to you? The government provide that particular communication to you. The question is there any mechanism to verify or challenge the correctness of the communication that is made by the government? If I am a supplier, if the government is putting my credits into a restricted category, is it not that I should be given an opportunity to cross-examine or to opportunity to explain to the government as to why they should not consider my credit as a restricted credit? Or on the other side, suppose I am a recipient and certain credits are appearing as a restricted category. Is it not my right to ask the government as to on what basis and under what information you have considered this particular credit as a restricted categories? So somewhere I believe section 38 totally lacks this particular approach. There is no mechanism provided as to challenge the communication which is made by the government under section 38. It's not as simple as somebody uploading the return and somebody getting the credit. There are lots of computations which are prescribed in those situations. Like for example, if we look at the next position, that a person who has availed the credit of input tax credit of an amount that exceeds the unrestricted input tax credit available by him under GSTR 2B. So if your vendor has supplied you the goods, he has paid the tax to the government, but he has paid the tax to the government using his own input tax credit. And if the government feels that the input tax credit used by him is in excess of certain percentage, or he has violated that conditions of availing the input tax credit which is prescribed in these rules, then also government will put that particular credit into a restricted credit mechanism. So the question is, to what extent the government will drain it down? It's not just your input service that the government is looking at. It is also looking at the input service availed by the supplier and whether he has taken the availed the credit correctly and or not in order to allow you the credit which is given in respect of the supplies made by him. So again, how this particular system is going to check all these things, and whether the supplier or the recipient should be given an opportunity of hearing in cases where this restricted credits or mechanism is implemented. So this is one aspect that is highly missing in this entire provision. So opportunity to both supplier as well as receiver to check or verify the correctness of the system computed communication. This is totally lacking somewhere in the current budget, which according to me is necessary having regard to the principles of natural justice. And especially when you are having an impact on my vested right on something for which I have already paid the money to the recipient, to the supplier of the goods or services. So this is one thing one needs to understand. Then there is also another condition. The next circumstances where it can be, suppose a supplier has utilized the credit in spite of the fact that he was not supposed to utilize the credit, then also this particular credit will be falling into the restricted category, and you will know how a system is going to check all this condition. I think there should be some white paper which will tell you as to how the system is going to identify all such cases. What is the logic that system is going to use in order to identify such cases? And once that white paper is published, probably the consultants, representatives, trade bodies should be allowed to give the representation on whether the logic which is inbuilt into the system in order to identify systemization is correct or not. What are the circumstances in which this logic should be failed? Only if these kinds of things are done, then probably one should bring such kind of a provision. But if in the absence of all this mechanism, if these provisions are basically brought and these provisions are implemented, then in my view somewhere this is not really in a good legal sense a correct way of handling the things or executing the law. So this is as far as the that particular condition is concerned. While talking about section 4912, the law now not only restricts the availment of the credit, the law has now delegated the powers to prescribe rules, to put restrictions on the utilization of the credits as well. So whatever we were right now talking about under section 38 or under section 16, those were the restrictions which the government had put on the availment of the credit. Having availed the credit, now that the credit becomes yours, it is the money which is lying in your passbook, in your electronic credit ledger, the government can still impose the conditions for the purpose of restricting the utilization of the credit for the purpose of making the payment of tax. Now, what I felt, friends, is that, okay, there are circumstances where the utilization may also be required to be restricted. But whether this restriction should form the part of the rule or whether restriction should form the part of the act itself, that is where one needs to really look at, because when it becomes a part of the act, then it follows a proper procedure. Somewhere when you are leaving it to the rule making power, it may suffer from an excessive delegation, and this is where probably one may have a little bit apprehension that the manner in which these provisions are coming, whether there could be a risk of excessive delegations under the garb of the power which is given under section 4912. It's so open-ended today, the manner in which it is worded, that probably any condition which would by putting any condition under any circumstances, the government would be in a position to ask the people to not utilize the credit. So sometimes if tomorrow they bring that irrespective of anything, you cannot utilize more than 80% of the credit which is lying in your electronic credit ledger, that would be considered as a valid amendment, that would be considered as a valid rule, because the act has sufficient backing to provide such rule. So in my view, one need to really think whether such kind of an excessive delegation is to be welcomed or it's to be represented against. So this is also one aspect of this budget which I am and let me tell you why this provision has brought in. This provision has been brought in order to give support to Rule 86A. Rule 86A has got some logic behind it. If there is a person who has availed a credit on bogus invoicing, if there is a fraud which has happened, and if as a result of the fraud the government wants to restrict further spread of that particular fraud, then in spite of the fact that the particular person has availed the credit, the government may tell you cannot utilize the credit. Now here the fundamental is that the availment of the credit in itself is a bogus. So the question of restriction of the utilization does not arise. Although it has been represented as if it is utilizing the credit, restriction on the utilization of the credit, but still in my view in such cases. So what are the cases which are covered under Rule 86A? Suppose you have taken the credit, but the person who has taken the credit, that is a recipient, is absconding, or a person who has sold the goods is absconding and has got no running business place, if the government finds out something like that, or suppose the government comes to a conclusion that there are no goods or services which are provided, only in these cases the rule 86A will come into play. In my view, these cases should form the part of the main act and not the part of the rules. So if at all there are any conditions relating to the utilization, restrictions on the utilizations of the credit, it should be the part of the main act and not the part of the rules. So that is one disappointing feature of bringing section 4912 into the GST law. So just three things which I just discussed just now is section 16, which brings that condition, additional condition of the restrictions of the restricted credit. The second is section 38, which is basically dividing all the credits into the eligible credit and the restricted credit. And number three is the section 42, section 4912, which is putting restrictions on the utilization of the credit. So these are the three concepts which, really speaking, are not in line with the proper judicial or proper legislative framework, if you really ask me. Now let's come to the next challenge. Suppose there is a basic fundamental, I would say, ambiguity as to whether the concept of restricted credit, whether it is qua SSC or qua credit. See, the conditions which are prescribed in for the purpose of putting or classifying a particular credit as a restricted credit are more based on the behavior of the SSC. So if the SSC does not file, if there is a difference between GSTR 1 and GSTR 3B, so somewhere if the system is classifying, or I would say marking, not a transaction, but the SSC itself as an SSC in whose case the credit is to be restricted, then the question would come as to what would happen to the transactions which were earlier already reported and were communicated to you as a eligible credit. Just to give you an example, suppose there is Mr. A, he is supplying you the goods, you have made in the payment of taxes, he has paid the taxes to the government. All the credit which is basically given by him was communicated in the GST portal under that form 2B as a eligible credit to you. So for the month of, say, July, August, September, October, 4 months, you took the credit as reported in GSTR 2B as an eligible credit. Now, suppose in the next 3 or 4 months something went wrong and certain credits, he is probably falling in one of the criteria which is mentioned in that particular 38.2, the list which is mentioned in section 38.2, because we don't know whether these criteria will be tested by the system every month or they will be tested by the system after every 3 months, or how. So suppose after a few months the system identifies that particular person as a potential risk and put the particular individual in the restricted credit category. The question that comes to my mind as to how are you going to then treat the credit which is already taken? Would you be required to reverse the credit? Would you be required to reverse the credit along with interest? When you would be entitled to take the credit back? When you will be required to reclaim the credit back? So these particular provisions, in my view, are still not very clear. So there could be a possibility. Only the rules, the manner in which it will work, will throw a further clarity on it. But there is a possibility by which certain credits which are taken by you may be shifted from an eligible credit to a restricted credit category. Similarly, certain credits may be shifted from a restricted credit to eligible credit category throughout the period for which you are taking the credit. So this reconciliation one needs to really keep. So earlier, when we were because see, we are all chartered accountants, so we know whenever we prepare a books of accounts, whenever you incur any expenditure, and whenever there is no doubt about the general eligibility of the credit, we all identify the tax portion separately and we consider it as our SENVAT credit and we show it as an asset. So whenever any invoice is raised, the tax is reported separately as an asset, expenses reported separately. That tax which is reported separately by us, we consider it as a self-assessment tax, self-assessment credit, as has been recently held by Honorable Supreme Court in the Airtel case, in the Airtel matter, that 2B, 2A, all just a facilitation measure. The credit has to be claimed on the basis of the invoices, agreements, books of accounts, financial records, which are maintained by the SSC on a self-assessment basis. So if that is something which one needs to see from an accountant perspective, then whatever invoice or whatever payment you record in the books, that becomes your basis for the purpose of taking the self-assessment credit. Now, what the law says is that forget about the self-assessment credit. You take out of that self-assessment only so much of the credit which is being reflected in GSTR 2B. So the first reconciliation you have to make is the reconciliation between the self-assessment credit to 2B credit. Then the law says not just the credit which is appearing in 2B is sufficient. You have to also bifurcate this into two categories: eligible credit and restricted credit. So there has to be further two ledgers. One, self-assessment credit. So everything is debit to the self-assessment credit. From there, some portion will go to the eligible credit, some portion will go to the restricted credit, some portion will go to the credit which is not appearing, or that particular credit will remain in that particular self-assessment credit. Then only the credit which is shifted to an eligible credit, you will be able to claim the ITC. That is how the entire process will happen. And suppose in the meantime, certain credits are shifted from eligible credit to restricted credit, or restricted credit to eligible credit, then you will have to accordingly pass the entries to keep your records properly reconciled. So very cumbersome, tedious, time consuming, extremely I would say tedious job of doing this reconciliations, which the chartered accountants or the accountants are required to do if they want to truly and in spirit and in letter wants to fulfill wants to comply with the provisions relating to an ITC. So this is one aspect I wanted to bring to your attention, that law has now actually gone into a step far beyond what was earlier contemplated in the original concept of the GST. The credit is now divided into self-assessment credit, uh, eligible credit, restricted credit. Then there could be a change in category from eligible credit to restricted credit to eligible credit. And ultimately what is being allowed to you is only that credit which is eligible at that point in time when the government authorities come to you and they finally find that according to the reports which is made available to them, only this much amount is considered as an eligible credit and all others are restricted credit. So all these problems are going to come in a time to come. So one needs to be really prepared. Again, only the rules, the manner in which this new methodology will be implemented, that will throw a further clarity on this particular aspect. Now, while talking about section 38, so section 16 amendments, which gives a statutory force to the restricted credit concept in the GST return. Section 38, which gives a statutory force to the restricted credit portion in the GSTR 2B. Now, what has changed is that because now the self-assessment credit concept has been done away with, because you can't claim the credit on the basis of your own assessment. You have to claim the credit only based on this GSTR 2B eligible credit criteria. Because of this, somewhere that self-assessment concept has been done away with, and therefore there is only a unidirectional flow concept. So only if something is appearing in 2B, you are entitled to take the credit. If something is not appearing in 2B, you are not entitled to take the credit. There are issues as to what would happen if there is a timing difference between appearance in the 2B. So if you have taken the credit in the month of June, but it is appearing in the GSTR 2B not in the month of June but in the month of September, then whether the credit to that extent would be considered as an irregular credit or not. So that is another branch of litigation that would come when you are talking about this. So this unidirectional flow of or unidirectional credit mechanism, which has done away with the principle which were laid down by the Supreme Court in the Airtel matter, in my view is the biggest worry. Consequently, section 42 and 43, which were talking about the mismatch, what would happen in case of a mismatch, has been done away with. There was section 43A, which was basically talking about the responsibilities or the liabilities in case of the mismatching. This section was enacted but never was implemented in real sense because the prescribed rules were never in place. And therefore, to that extent, this section was introduced and never saw the light of the day. It basically was deleted, omitted by this present bill. So 42, 43, 43A all gone away with. And what has changed? We have got a new section 41. So earlier section 41 was allowing us the credit on a provisional basis. It would mean that you can take the credit on a provisional basis irrespective of whether the conditions of section 16 were getting fulfilled at the time when the availment was happening or not. So even if section 16 condition was not happening at the time of availment, still you were able to get the credit. So somewhere there was again a dispute amongst the professional whether this provisional assessment concept is attributable to all conditions of section 16 or is attributable to only the conditions pertaining to the mismatch of the credit, which are for which the elaborate mechanism is prescribed under section 37, 38, 42, 43, whether to that extent this provisional credit is to be made limited. So that was earlier the dispute, or I would say not a dispute, but a point of discussion between the professionals, discussion between the professionals. But when it comes to the new amended section 38, because the old section 38 was actually dealing with the changes which were being allowed to the SSC while accepting or denying the GSTR1 findings of the supplier. So earlier under section 38, which was never operational, the law provided the recipient to make the changes in the GSTR1 filings which are done by the supplier, which were getting reflected in 2A. So it was allowed for the SSC to make the changes to claim his own credit. But now that particular section 38 has been done away with, and what we have is a new section 38, which I just explained, which allows the concept of a eligible credit or a restricted credit on a unidirectional basis. And now, based on this, section 42 has also undergone a change. So the concept of a provisional credit has now been taken away with. There is a concept of a self-assessment credit, which is still there. So the word self-assessment credit has not been done away with in section 42, which gives some ray of hope while interpreting these provisions in a beneficial manner. But what the law says, if in case the supplier, you have to take the credit on a self-assessment basis, that is what the law says. And suppose the supplier has uploaded that particular, the supplier has not uploaded his particular invoice in the return. That means you have not received the communication, and the supplier has also not paid the taxes. Only in those cases. So somewhere section 42 requires, 41 requires you to fulfill two conditions. Condition number one is that not the communication by the system to you as far as that credit should be there. And second, the supplier should have paid the taxes to the government. If these two conditions are not getting fulfilled, then one need to reverse the credit. One needs to also pay the interest to the government, and only when the other party, that is a supplier, makes the payment of taxes to the government along with interest, then you would be able to reclaim the credit which was reversed by you. So surprisingly, in section 41, the liability, the prime liability in case where the invoice is not uploaded and where the tax has not been paid, the prime responsibility is placed on the recipient and not on the supplier, in spite of the fact that something is appearing in GSTR, in spite of the fact that something is appearing in GSTR 2B, but the tax has not been paid. Still, it appears that the responsibility of reversing the credit is placed on the recipient. Suppose the other party makes the payment of tax, then you can no doubt re-avail the credit. But the interest portion that you have paid, that goes to the government. You are not allowed to adjust that interest portion because no provision in that regard has been made. So this is again, in my view, not a very welcome step as far as section 41 is concerned. Whenever the other party makes a payment along with interest, in my view, the interest credit should also be given. I will just, for the sake of benefit of all, read the second subsection of section 41. What it says, that the credit of input tax availed by the registered person under subsection 1, in respect of such supplies of goods or services or both, the tax payable whereon has not been paid by the supplier shall be reversed along with applicable interest by the said provision in the manner as may be prescribed. And under section 41(1), it says every registered person shall, subject to such conditions as may be prescribed, be entitled to avail the credit of input tax credit as self-assessed in his return, and such amount shall be credited to his electronic credit ledger. So somewhere the self-assessed concept is still there. The concept of provisional credit is not there. So one needs to really see what do you mean by this self-assessed. So that is really going to be a legal interpretation in a time to come. How would you interpret the word self-assessed? And suppose a particular credit is availed by you, but in respect of that particular credit, the tax has not been paid by the supplier, then you will have to reverse the credit. So whether it would cover only those cases where something is not appearing in GSTR 2B, or it would also cover the cases where something is appearing in GSTR 2B, but the tax has not been paid by the supplier, and therefore probably these credits are appearing in the restricted credit category, and therefore you were not allowed to take those particular credits, and still you have taken the credit. What is the scope of section 41(2) that one needs to really see in a time to come, how that particular section 41(2) would be interpreted in the law. So these are the 4 to 5 sections. Again, section 16, which was basically giving conditions, the whatever the conditions were there prescribed, that conditional credit authority given to it under section 16. Section 38, dividing into eligible and restricted credit. Then we have got section 41, which is saying in what cases the responsibility to make the payment is on the recipient, how that he has to pay tax along with interest. In case the other party pays the tax, he can take back the credit, but no provision for readjustment of the interest. There is no clarity as to how that particular person who has reversed the credit would be in a position to know, or he will be aware that the other party has made the payment of tax. So again, there is no clarity as far as that particular aspect. Hopefully there would be some additional reporting which would come in GSTR 2B, but again, to what extent the person would have a right to uh, question or challenge the correctness of that particular communication is again a question that one needs to really see. And even otherwise, under section 38, there is no provision which is very apparent, which says that even such cases would be covered under section under communication made under section 38. There is no provision which says that these reavailment cases will appear in GSTR 2B. No such provisions have been made there. So again, a gray area as to how the person will come to know regarding the reclaim of the credit. Another important aspect is what is the timeline, whether this reavailment of the credit may be permissible after 10 years. What is the timeline within which I am supposed to reavail this particular credit? This is also not very categorically addressed in these particular provisions, and therefore there is a lot of fog mist in the manner in which these particular provisions are going to be implemented. Having said so, I think we have completed the input tax credit aspect. The key takeaway in this particular provision is that the input tax credit mechanism has become more and more difficult. More and more conditions have been prescribed. One may say it has become very easy because you have to only take whatever is there in GSTR 2B and not otherwise. But if you take only something which is there in GSTR 2B as a unrestricted credit or an eligible credit, somewhere I think it will have some implication as far as the cash flow is concerned. And as I have already explained to you, the reconciliation that you have to maintain as far as the self-assessed credit versus the eligible credit, the cash flow that you are going to face as a result of different timings in appearing that particular credit in your GSTR 2B, the possibility of the department demanding interest. So if you claim the credit in the month of January, and if the particular credit appears in GSTR 2B of April, then for 3 months, whether the interest is liable to be paid or not. These are some of the aspects that one needs to really see. It is going to come in the time to come. Now, having said so, let me now take you to the other amendments. So certain other amendments have been prescribed. For example, very good. Uh, they are being portrayed as a very good amendments. Like for example, a time limit for making the amendment under section 16 was earlier up to September or annual return. So that September has now been extended to 30th of November. So up to 30th of November, if you have uh, uh, if you are now allowed to make the amendments. So same is the case with the credit notes adjustment. So any rectification in the return or any rectification in the statements which are furnished under section 37, that is GSTR 1, or any credit notes for which the earlier time limit was only up to September, you are now allowed to take it, allowed to make it anytime before 30th of November of the next financial year. So in a way, it's good. 3 months period has been increased, but the question that needs to be asked is whether it is sufficient, especially since if you do not allow a particular person to make any changes in GSTR 1 after 30th of November, then that particular person may lose his entire credit. So B2C to B2B amendments not happening. The system does not permit you after 30th of November, or there is some GST registration number related default. System is not permitting you to make the amendment. All these things are whether 30th November can be said to be a sufficient timeline or not, or it should be what we consider as a 3 years from the end of the financial year. That should be the deadline, because somewhere 3 years from the end of the financial year, I think most of your problems will be highlighted. And even after that, so somewhere this law of limitation, to what extent this 30th of November is said to be a reasonable date for in the revised circumstances, is something one needs to really see. So don't be under the impression that the government was kind enough to increase the date from September to November. It is probably always better, or it was probably more logical to increase the date from September to November, because in any way the tax returns and most of the accounts are getting finalized in the month of September only. So 2 months thereafter was anyway required. But now under the revised GST model, under the revised ITC guidelines, whether this 30th November also can be said to be sufficient or not, that one needs to really introspect and decide whether to what extent that would suffice the purpose. Now, having said so, some changes have been made in strengthening the compliances. So your GSTR 1, you cannot file your GSTR 1 unless you have filed your earlier GSTR 1. So filing of the GSTR 1 is now compelled in a sequential manner. Probably this will help the government to devise a system to identify the cases where the restricted credit can be quantified. So therefore, the systematic filing of the return is being emphasized. All GSTR 1 to be filed systematically. If you have not filed GSTR 3B of the preceding month, then you are not allowed to file the GSTR 1 of the subsequent month. So this is again a compliance-based strengthening, so as to make the people who file the returns in a sequential manner and in a timely manner. That is the second aspect. The third aspect is some anomalies were there. So in order to bring all the GSTR 1 in line with each other, the non-residents GSTR statement of outward supply, which was otherwise on 20th of the next financial year, has been now preponed to 13th, in order to make it in line with the other provisions. So that is also one important aspect that one needs to realize. Then the next aspect is certain trade facilitation measures have been made. Or before that, as far as the cancellation of registration were concerned, earlier the cancellation of registration for a normal SSE, if there was a continuous default in filing the return for a 6 continuous period, then only the cancellation of registration was one of the possibility. And we have seen that in the past, in spite of there being not a continuous default for 6 months period, still the SSEs were facing problems in getting the registration cancelled. In fact, one of the case was also reported before the Madras High Court, where the court very categorically said that this 6 months default should be there not only at the time of issuing the show cause notice for cancellation, but also at the time when the order for cancellation is passed. So in that case, at the time when the show cause notice was issued, the 6 returns were pending, but subsequently the SSE filed 1 or 2 returns. And at the time when the final assessment order, revocation or cancellation order was passed, only 4 returns were pending. The court held that it is an incorrect case of cancellation unless and until the six tax periods returns are outstanding also as on the date of the issue of order of the cancellation is not correct. So now this 6 months tax period has now been further reduced. We don't know what that reduced period would be. It would be prescribed by the rules, but definitely it would be not as high as 6 months. It would be maybe 2 or 3 months only, if my guess is right. So that is one change that they have made. Some cosmetic changes as far as the composition dealer, because earlier there was a quarterly return filing system for the composition dealer. Now there is an annual return filing system. So in their case, this cancellation provision would be applicable if the returns are not filed uh, for 3 months after, even after the 3 months of the financial year. So that is what the provision has been made as far as the composition dealers are concerned. So these are some small cosmetic changes. Now, as a trade facilitation measure, I would say one very important welcome change which has been made is that if there are multiple registrations made by the same person having the same PAN, and if there is some cash which is lying in the electronic cash ledger of say one entity, or one what we call it as a distinct entities under section 25, the entities which belong to the same PAN but which are having different registration either in the same state or in the different state. There obviously sometimes while making the payment, the accountant may make an error, and instead of registration A, he make the payment in registration B. Their problems have been attempted to be solved by allowing them to transfer that credit from one registration to another registration, subject to only condition that there is no outstanding liability which is there as far as in the registration in which the wrong tax payment has been made. So subject to that condition, now the transfer of the taxes from one registration to another registration of the same PAN based entity are also provided. In the earlier budgets, this provision was made only qua the types of ledger. So CGST credits can be transferred to IGST credit, and like that it was allowed. Now even the registration wise transfers are being allowed under the suggested amendments. So this is a good step. Another good step that they have done is when it comes to the refund provisions. The specified international organizations, the input tax credit refund, which was otherwise allowable to them, they had to claim it within 6 months. Now they have been brought at par with other SSEs, and they can now file the refund claim within a period of 2 years. So that is also a welcome step. The third step, they have tried to put an end to the controversy as to whether a SEZ can apply for a refund or not. So earlier department was taking the view that SEZ receives a supply which is a zero rated supply, so therefore they are not entitled to file the refund claim. Now they have inserted a provision in the explanation suggesting that in case of a SEZ, the relevant date would be the date on which the zero rated supply has been made. So somewhere they have tried to give an indication that even SEZ can go for a refund claim under section under section 54. So again, that is a welcome step when it comes to the refund. One another aspect that they have tried to change in the refund is, suppose earlier the inverted duty structure refund, where it was possible to withhold that refund under section 5410 if some returns are not being filed by the person or some liability has not been paid by that particular person under section 5410. So earlier that withholding of the refund was only allowed in cases which were covered under section 543, that is inverted duty structure. But now they have increased that particular mandate to all the refund cases. So in all the refund cases, the government has been empowered, the authorities have been empowered to restrict your refund if there is an unpaid liability which is there as far as in your case. So that is another a negative side, but there is nothing wrong in it. If you have not paid the taxes, then obviously the refund should not be granted to you. So a logical provision, a rational provision. So these are some of the other provisions strengthening the compliance, where the time limit has been extended from September to November, and another cases where some trade facilitation measures have been taken, or some anomalies have been removed from the law. So these are some of the amendments as far as the GST is concerned. And now let me come to the last part of this amendment, which is a retrospective amendment. So very importantly, section earlier there was no goods and service tax common portal. So the common portal notification actually came very late. So there was, technically it was possible to argue that from the time the common portal was notified, a period prior thereto there was no common portal, and therefore nobody can be held responsible for not filing the returns. It was a technical argument that was possible. So obviously they have tried to rectify it by bringing an retrospective amendment, saying that now the common portal will be deemed to have been applicable from the day of the first notification, that is from 26th June 2017, and it will be deemed to be operational from 1st of July, except e-way bill portal. So that is the retrospective amendment that they have made. The another retrospective amendment that they have made is section 53, where they have said that very importantly, section 50, the manner in which it was worded earlier, it was giving an impression that in case of an irregular availment of the credit, the interest can be levied only in those cases where there is a mismatch happening as a result of section 42 and 43. So only in cases where there was a mismatch as a result of 42 and 43, the interest would be applicable at the rate of 24%. And in all other cases where you have taken the credit incorrectly, those credits which were falling under section 17(5), you have taken the credit and if you have to reverse it, probably there was no provision for not allowing the credit at all, or not, for recovery of the interest at all. So anyway, that 42, 43 remained on paper. It is now omitted. Having seen this, a retrospective amendment from 1st of July has been made to suggest that if the credit is availed and utilized, only then the interest at the rate of 18% would become payable. If the credit is availed but not utilized, then the question of making the payment of interest would not arise. So this availment and utilize, the concept which was there in the earlier service tax law, has now been brought in the GST law also. In my humble view, that concept was already always there, because unlike in the case of the service tax law, in case of the GST law, till the time the liability is created, there cannot be any interest. And the only way to create a liability is when there is some movement in the electronic liability ledger. So if you take a credit in the electronic credit ledger and utilize it by transferring it to the electronic liability ledger, only then the question of interest would arise. If you take the credit in the electronic credit ledger and before it is being transferred to the liability ledger, if you reverse that credit, then in my view, anyway, the question of levying the interest should not have arisen. So that is how the law was being interpreted by me, at least earlier. But I think now with the retrospective amendment, this is made more clear that unless something is availed and utilized, the question of interest would not come into play. So this is as far as the retrospective amendment as regards section 50. The rate of interest has also been reduced from 24% to 18% by making the necessary amendment in that notification. Then comes the third exemption, which is given to the fishing industry. So at the time of, so the fish meal is basically a product which was attracting a nil rate of tax under, I think, serial number 122 or 112 of the exemption notification. There were certain concerns that at the time of preparing the fish meals, certain residuary byproduct is getting generated, which is not really having a commercial value, but it is being sold as a byproduct. So what would happen to that? So only for that limited purpose should we have to take a registration. So there their concerns are addressed by giving a retrospective amendment and saying that all other byproduct except fish oil, if you have sold and if you have not paid the taxes on it, then nobody can recover those taxes from you. It is deemed to be an exempted. But if you have already paid the taxes, then obviously there is no provision consideration, in exchange for certain consideration, was not deemed to be a service. But subsequently, I think somewhere in 2016, the law underwent a change, and the word support services was removed from the law, and all services provided by government to the business entity were considered as taxable. And there this question came as to whether, first of all, issuing of the liquor service license is a service at all, and if yes, then whether the reverse charge would be applicable on it. And lots of notices are being issued to many people on this particular point, many restaurants on this particular point, that you have not paid GST on the liquor license. So there, then the clarification in the form of a retrospective amendment came in, I think, 2016 or I think 2019 budget, saying that all those cases where the consideration is paid for such liquor licenses would not attract a GST. They are exempted from service tax. Would not attract service tax. They are exempted from service tax. So that retrospective amendment came, and then came the GST. In GST, again, the same story was repeated. As regards the liquor licenses, no specific exemption was given, and therefore now, by virtue of the present budgetary amendment, they have granted a retrospective amendment from GST in respect of this supply of liquor license to the restaurants, or any fee paid for the supply of liquor license or application fee for the period 1st July 2017 to 30th September 2019. That is what, thereafter the exemption was specifically granted. So this is how the retrospective amendments have been incorporated in the law. So looking at the overall budget, as I have told you, three basic concepts: provisions relating to the ITC, in my view, very harsh provision, needs a specific thought process, whether the adequate mechanism is there, whether the opportunity of natural justice to the people whose credit the government will classify as a restricted credit should be afforded to them or not. These are some of the fundamental concepts which are not really given a thought to in this particular budgetary provision. The taxpayer will suffer as a result of this cash flow issues. Somewhere it feels that the attempt is being made to make the money out of the mistakes, inadvertent mistakes, that the taxpayers are going to make. Not a very welcome scene when it comes to any government, that the government is thriving on the late fees, or government is thriving on the mistakes of the SSC. So to that extent, certainly not a very good provision. At least to me, it appears to be very exorbitant. And yes, the adequate mechanism as to what would be the actual impact, how the restricted credits would be quantified and communicated by the government. Any policy document to that extent, like for example, when GSTR 2B was introduced, which cases will fall into the GSTR 2B for a particular month, were specifically told to the public by issuing that particular press release. Like that, how a government mechanism will identify the cases which were listed in the restricted credit category, that logic should be somewhere made public in order to increase the transparency in the entire system. So that, I don't know to what extent the government has thought of incorporating or introducing such kind of a press releases in a time to come. This is as far as the ITC is concerned. I think I have tried to cover whatever GST amendments, very important GST amendments which have brought by this budget 2022. If there are any questions, I am welcome to address. Yes, Omkar.
Thank you, Mandar sir, for the detailed analysis. I request if any participants have any questions, please feel free to ask it to the faculty. I know, see, sir, you have gone it in very detailed explanation. So I believe there are not much, but we'll just wait for a few minutes to have any build-up of questions. So in the meanwhile, if you don't mind, can I ask a couple of questions?
Yes, please.
Okay, so now, so this provisional credit that has been again introduced through section 41, I mean, which was always there, but then now that section 41 will be again having a different color, that if the supplier's data is not uploaded in the GSTR 2B, then probably you will have to reverse the input tax credit along with interest. Again, as and when he uploads the same, we are able to claim the credit. Now, I just had this thought in mind that when it comes to the reversal compulsion of input tax credit over here, vis-a-vis that amendment in the section 50 subsection 3, which has been focused at, where the interest has been only in the factor of availed and utilized. Now, I was just trying to make a correlation that if at all the availment and utilization is the only problem area, then in this case, it will be only interest just by way of availment, or it will be an availment as well as utilization when it comes to the credit that we have availed and which has got a provisional credit tag to it.
Yeah, so section 53 very categorically mentions about the levy of interest. Section 38 or section 41 does not speak about the levy of interest. They are only talking about interest as may be computed under section 50. So very clearly in the method or in the manner in which the ITC is to be utilized. If we look at those rules, then if you suppose today take a credit in respect of an IGST and that particular credit is not appearing in 2B, but still if you take it, it would be very difficult for you to keep a balance of IGST credit because the law requires you to utilize your IGST credit fully. So in that case, that particular credit gets utilized and then you will face a problem. So therefore, yes, utilization is required for the purpose of triggering the interest. But when it comes to section 41, availment and utilize of a credit which is not appearing in 2B or which is appear or in respect of which. So instead of using the words not appearing in 2B, I would use the word in respect of which the supplier has not made the payment of tax. So how a 2B is going to identify those cases where the supplier has not made the payment of tax? So probably there will be two columns. One column, the filing of GSTR 1, another column, filing of GSTR 3B. And in cases where the filing of GSTR 3B is not there, there probably the presumption would be that the tax has not been paid by that particular person and you will be required to reverse the credit. So whether it will cover those cases or whether it will cover only those cases which are not appearing at all in GSTR 2B, there some confusion lies. So that is one aspect that one needs to consider.
Okay. Yes. Any questions for from the participants? Anybody has any specific question? Please feel free to ask. So in the meanwhile, I'll ask my next question. So now also there is one provision regarding the I think we have a participant asking question. What is the difference between availment and utilization? So I think that is the first question by Mr. Mohanji.
Yeah. So availment, as I've already explained to you, availment means when you are taking a credit in your 3B and that particular credit is credited in your electronic credit ledger. Okay, that becomes an availment. When a particular credit is debited to the electronic credit ledger and is credited to the electronic liability ledger, in that case it becomes a utilization. So utilization necessarily means a debit to your electronic credit ledger and credit to your electronic liability ledger. Suppose you reverse the credit without giving any impact to the electronic liability ledger, and according to me it is not a utilization of the credit. It's merely a reversal of the credit with before utilization, which the Supreme Court has in many cases held that it is a non-availment of the credit. It is equivalent to non-availment of the credit. So that is the difference between the availment and the utilization.
So the next question is input tax credit of imports which is not appearing in GSTR 2B. How it will be dealt with?
No, so this section 37, if you look at the scheme of the act, only those cases which are covered under section 37 are basically brought into the section 38 or the communication under section 38, because uploading of the return and communication both are the important condition. So something is not required to be uploaded the communication under section 38 is not really speaking a problem. So import cases would never be coming under the purview of this particular mechanism.
Okay. All right.
I think the question is asked in the context because I think in today's GSTR 2B there is one particular tab which gives you also the import related information.
Yeah.
But fortunately or unfortunately, section 38 does not speak about it as of now, not very clearly. Now, if something comes into the rule, and if the rules incorporate that condition, then one needs to see how far that rule would be considered as a valid rule. But because when it comes to the restrictions, if you look at the last restriction, then it says that in respect of any class of persons as may be prescribed, any such other classes of person as may be prescribed. So if such importer is considered as one of the classes of person, then one needs to so that is the basic issue about the delegated legislation anyway.
Okay, there is another question. What will be the accounting entry for GSTR 2 and 2 when it is to be availed? Nazir sir, can you please ask it by unmuting? I don't think it is getting a clarity. What will be the accounting entry for GSTR 2 and which return?
Yeah, and when is the entry to be passed? When is to be the credit to be taken in the books of accounts?
No, so as I've told you, we all know, forget about the GST. Your books of accounts are to be prepared based on the normal concepts of accounting. So whenever a particular invoice is booked, generally in all SAP or all systems, nobody is waiting to check whether it is appearing in 2B or not. In all systems, when the invoice is booked, the tax portion thereon is separately recorded. But that tax portion, that ITC ledger may not be the appropriate ledger for the purpose of availing the credit. So your first entry obviously would be expense ITC to creditor. That would be the first entry. Now that ITC GL will be a self-assessed ITC GL. So from there, when you are filing the return, you will have to make another entry. Those items which are appearing in 2B, you will have to park it to the different ledger, like from ITC ledger to ITC eligible ledger and from ITC ledger to ITC ineligible restricted ledger. So like that, the entries would be required to be passed. So the next entry would be ITC eligible account to ITC account, or it could be ITC restricted credit account to ITC account. These would be the two entries which would be passed. And when ultimately when the utilization takes place, it would go only from the ITC eligible to the ITC to the final liability. So there the liability account will be debited and ITC eligible will be credited. And in the meanwhile, if there is any shift from eligible to ineligible, then you will have to pass an entry accordingly. So that will then be shifted from a ITC restricted debit to ITC in eligible credit. So to that extent, for that month, your ITC eligible account might show a credit balance. So because that credit is already been availed by you, or it is already been transferred by you for the purpose of return. So which might result into some sort of an interest liability if that falls into the scope of section 41(2) as we just saw. So that is where the problem would come.
Yeah, thank you.
Okay. So, sir, I had another question. Now, there is one more amendment which is proposed in section 49, which come with respect to something that had taken place. So, if I could ask you to refer to the subclause 12, amendment of section 49, serial number 109 in that subsection 12. Compulsive cash payment now, which was probably, in fact, which was tried to bring in by way of amending Rule 86B last year, whereby they had put up that 1% of the tax will be required to be paid in cash, irrespective of the balance in input tax credit. But that time there were a lot of compounding, corresponding relaxing exemption sort of things given to that. If you have paid income tax in excess of 1 lakh rupees, then you will not be required to do so. And basis that it was not really happening. But now that they have again proposed to bring in this compulsory portion of tax payment, what probably would be the range should it be in somewhere between 1 to 5% of a compulsive cash payment?
See, as I've told you, any compulsive tax payment in my view is not correct. Okay. That's why in my entire address I've told you. In fact, now they are bringing this provision in the act. Earlier it was not there. So to that extent, Rule 86A and Rule 86B, both were was without any powers. The question is, this provision is worded in such a broad manner that it gives a lot of power to the government. So if I have to just read out that particular provision, it says, notwithstanding anything contained in this act, the government may, on the recommendations of the council, subject to such conditions restriction, specify such maximum proportion of output tax liability under this act or integrated tax, which may be discharged through the electronic credit ledger by a registered person or a class of registered person as may be prescribed. So the only thing which is important here, which probably we could give a more weightage to, is on recommendations of the council. So the question is, all these two amendments which are there in 86A and 86B, whether they were recommended by the government, the GST council or not, that one needs to really see, or these are the amendments which are made. And another aspect that one needs to really see is that whether the recommendations of the council are also required in the cases of rules, or it is required only in those cases where the law specifically provides it. Like, for example, in this section, the law specifically provides on recommendations of the council. So you require a recommendation of the council for the purpose of prescribing the condition. So even if it is a rule, the recommendation of the council is required. But if the recommendation of the council is not given in the law, is not mandated in the law, then whether it is still required to pass any rule or not, that is also one needs to really see, because this is coming for the first time. Earlier there was no recommendation required. Rule 86A, Rule 86B was in place. One needs to really see it is coming, whether it is coming through the minutes of the GST council, or it is a provision which is made by the executives themselves. That one needs to see, because it is not, rule is not something which is made by the legislative, it is made by the executives only. It is only laid down before the parliament for the purpose of approval.
Right. Okay. Any other questions for any other participants? Sir. Meanwhile, sir, I'll just put my last question to you.
Yeah.
So now when this the eligibility to claim input tax credit, the timeline has been extended to 30th day of November, or is proposed to be extended to 30th day of November of the subsequent financial year. Now, one thing is that earlier there was a practice that all the pending credits which were being assessed and taken or availed, that was being done along with a return for the month of September, which was following the end of the year. So technically, it used to happen by 20th day of October. And there was a significance to the return of the month of September, particularly because that was the linked due date of that return was linked to actually availing that credit. Now, having said so, in the given scenario, if it is proposed to be increased to 30th day of November, then probably any return from the period April of that year up to the September of that year, or maybe even for that matter, April to October, whichever returns are pending, in probably any of the returns, this credit might be claimed, because ultimately the time for, the claiming is dependent not on any return, but it is particularly dependent on the time limit per se. So over there is one drawback, that how that date can be, for that matter, considered for availing credit. Which return will be filed or allowed to be filed between 22nd of November or 30th of November. It will be only a belated return or late return of some particular month, let's say the month of October, for that matter. So there happens to be some thing that needs to be clarified. Do you agree on this?
No, so if you ask me very categorically, if you look at section 39(9), it says that rectification, see, frankly, first of all, is there any time limit for the purpose of filing of a return? That's the first question. So suppose I am not able to file a return for the month of July. July 2017 or July 2019, can I file the return now after in 2022? That's the first question that we need to ask. That I have not filed the return in July 19. Can I file the return for the month of July 19 in say February 2022? In my view, there is no restriction given in the law for that. The restriction is only qua the amendments. So in my view, all the pending returns you can file anytime. Now, what is meant by that 30th November? If you really ask me, I would take a view that you can file the return of November. 30th November means return of November of the next. So if you are talking about 2020, if you are talking about 21, 22, then up to 30th of November 2022. So from 1st April 21 till 30th November 2022, whatever returns are there, irrespective of the time when you file it, that is what my view is, irrespective of the time when you file it by 30th November 22, or you file it on December 22, file it on January 23, February 23, I think you should be able to get the credit. So the limit now is qua the return. So up to 30th November, if you are in a whatever returns are falling up to 30th of November period, even if you find it subsequently, in my view, you should be able to get the credit. Litigation prone, but in my view, you should be able to get the credit. And that's the reason I have initially highlighted that conditions are substantive. But what is the purpose of the condition? What is the purpose when the condition is saying that unless and until the other party has paid the payment of tax, you are not entitled to get the credit? The condition is very clear that till the time government gets the tax, if you take the credit, then it's like government has not got the tax, but still the SSC has got the benefit. This should not happen. That's the objective for which that credit has come. So all this matching and all this revision and all those concepts are ultimately procedural. As long as the basic purpose behind a particular provision is getting fulfilled, all other provisions, in my view, which are procedural in nature, has to be interpreted in a manner which will not basically suppress, or I would say suppress the mischief and advance the remedy. That is how that particular provision needs to be addressed accordingly.
So in a way, we need to just ensure that by 30th of November, that amount should hit my electronic credit ledger. Just to
I am getting one step further. I am saying even if it does not hit to your electronic credit ledger by 30th of November, but if it appears in the returns filed by you for the period up to 30th of November. So 30th November return, even if you file it in December or if you file it in January and it hits your electronic credit ledger in January, in my view, you should be entitled to get the credit.
okay. Yes, I think that was very perfectly put down. Yes. Any other participants have any question or? I will just wait for maybe another minute or so, and otherwise I'll begin the proceedings to formally conclude this session. All right. So first of all, on behalf of Thane branch of ICI, I firstly wish to thank Mandar sir for taking time from his extremely occupied schedule, because I'm very sure that there must be some more things lined up right up to 9:30 or 10 o'clock till now. Having regard to all the amendments that have been proposed in the Union Budget 2022, Mandar sir has obviously exhaustively tried to cover the intricacies, specifically focusing on the input tax credit aspect, because that is, as it has been also today mentioned in the Economic Times, that it's supposed to be a draconian provisions to really digest by the industry and by the entire trade body. However, sir has tried to go into a very depth as far as every section is concerned, and which was precisely the intent of calling a expert for today's session. The participants have, I am very sure that, endured a lot out of this, and it is always a pleasure to actually hear you, sir, because I've heard you back in 2015 and there onwards many a times, and therefore amongst the very industry stalwarts, he stands to be one. And I really thank you once again on behalf of the entire branch for spending your valuable time. I request all the members to give a round of applause in whichever virtual manner it is. So on behalf of the Thane branch chairman, Sri Asavaji, all the managing committee members and the managing committee elect members, on behalf of all the members, I once again thank you, sir, for your very distinguishingly deliberated session, and thanks for the time taken out. Any participants who have just forgotten to mention the specific numbers as well as your name for the purpose of CPE credits, please ensure that the things have been done in the manner in which it has been proposed. There was a message circulated at around 3:30 in the afternoon today for the rules for the VCM, and we will need to really stick to that. So kindly ensure that you have been adhering to it. So a very sound appreciation is being given to you for the session, and the members are really delighted to share those thoughts. So thank you once again. And here I would like to formally conclude this session for the day.